Okay, let's take a look at what they have here. This company began operations in 13. Property sold on installment basis. They recognized the income for financial purposes in the year of the sale. For tax purposes, it's recognized over the period of collection. So installment income was $720,000. So that's going to give rise to a temporary difference. That's going to be a DTL because we want to pay the tax on that later. And it tells us it's going to be collected over the years according to these tax rates. So let's just do the math while we're here. 30% of that is 48,000. That's a DTL. These are all DTLs. 40% of 390, because remember you recorded at the rate that it's expected to be paid at. So that's 156,000 DTL. And this is what, 68,000 DTL. Also keep in mind that the item is characterized in terms of how the item is characterized based on the characterization of the transaction that gave rise to it, okay? So what we need to do here is we need to figure out which of these are current and which of these are long-term. And it's really pretty straightforward. This is long-term. This is long-term. This is next year, so that's current, okay? So we have current DTL, and these are long-term DTLs. Now, the next thing we have to do, it says we have to figure out their pre-accounting income was $1,046,000. That includes $36,000 from municipal bonds, so we take that out right away. That's never taxable. That's a permanent difference. So that brings us down to $1,010,000. And from that, we need to subtract this $720,000 because that's going to be collected according to that schedule. So when we do that, we come up with the taxable income of, what is that, $290,000? And that's subject to 30% tax rate. And that gives us $87,000. So that's the tax payable right now. These are deferred tax liabilities. This is how they're characterized, current or not current. So let's take a look at this and go through piece by piece. We got the information, now let's go fill in our chart. First thing it says is, what is our income tax expense? Well, our income tax expense is the tax on the total income. So we have our deferred tax liability. Our deferred tax liability, we're going to back into our income tax expense because our total deferred tax liability is what, $272,000? Okay, $272,000. That's those added up. And our current tax payable, $87,000. And the plug of those two is our tax expense. So that works out to be, I don't know, $359,000. Okay. So next it says, what is our net income? Well, our pre-tax income is the total number. So we have the 1,046, or I'm sorry, 1,460 or 46,000 minus our 359. So that gives us our net income of 687. And then it asks us to come up with our current and long-term deferred tax liabilities. So our current deferred tax liability is this, and the sum of those is our long-term. So our deferred tax liability, the current portion, is 48. And we've got to add up the other two pieces, 156 and 68, 224. Okay? That's the whole deal.